All right. Dallas Brown, welcome to the program, sir. How are you?
Hey, Glenn, how are you doing?
I'm good. So I don't know if you know much about me, but I tend to think that we are running a shell game with our banks and our Federal Reserve and our central banks and our Treasury. And I think we've done such damage to our banks, and they are just printing money to keep everything looking like it's okay. I saw so that's my point of view, so you know where I'm coming from, and I want you to correct me, and enlighten me if you have anything better to say. I have not heard of Weiss Ratings before, but I know you guys have been around for about 50 years. And in the last bank crash, I think you guys were the ones leading the way saying, trouble. Isn't that correct?
Yeah, so we did. So I can get to both your points really quick, but let me just jump in and tell you who Weiss is and what we've been doing. So this analysis we did isn't something that we just did one time. We rate banks and many assets, stocks, insurance companies, bonds, and crypto daily. And so we see the movement that happens based on liquidity of banks, capitalization, stability. And so we're very vigilant. Our analysts were very vigilant about this. And so Weiss has been doing this. They started rating banks in 1971.
Okay.
And so Martin Weiss is the founder, and his father, actually back in 1930, his name is Irving Weiss. He predicted the failure of the Bank of the United States. And so that's where the catalyst of this came. And so in 1971, he got together with his son, and they started rating banks for safety for consumers. And so we rate every bank. And so it's not just banks, it's also credit unions. And so in 2008, we named in advance warning all the major banks that failed during that financial crisis.
I mean, you were I think the only guys that said Bear Stearns and Lehman Brothers are going.
Yep. So it was like weeks before Bear Stearns, and it was like 100 and some odd days before Lehman Brothers that we announced that they're gone. Like it's an end game with them. But since 2008, there's been 539 bank failures. And we have given advance warning on 535 of those. And some of those other ones were fraud. Yeah.
Okay.
And so this isn't something that we take lightly here. It's important. It's important for consumers, but we kind of agree with you. It's not the bank's fault 100%. It is the government. It is the government forcing them to push this money out, not letting the free market play a key role in regulating the banks. And they just keep stepping in to protect banks, protect them from the market, and it's created this monster that's going to be tough to fix or save.
Right, and it's only really benefiting, at least at this point, the big banks. Everything keeps getting folded in to these banks that we said were too big to fail, and so we got to make them smaller. Back in 2008, they're just getting bigger and bigger and bigger and bigger. I mean, it feels like we're going to end up with, just a Bank of America.
Well, hopefully that doesn't happen, because that's not good for anybody in our country at all.
Right.
I was talking with a president of a regional bank not too long ago, and he was talking about a nationalized bank, and I'm just like, why are you even talking about this? This is not something that we want to be discussing. Like,
correct.
We need the privatization. Yeah.
So go ahead.
This is what we found. Yeah, this is what we found. So basically what's happening is, because of how quickly they raised interest rates, right? Mm-hmm. There's a lot of banks that are holding bonds. And when someone comes and does a bank run, or we have a lot of people taking out deposits, especially ones that have high uninsured amounts. So that's people that have over the 250. The banks start having a crisis. And if they don't have the liquidity, or they don't have the cash to cover those, like a typical bank run, they have to sell their bonds. And on their balance sheet, the bonds are marked or held to maturity. And so they have them marked as if they were going to sell them in 10 years and 20 years and 30 years. But then they have to take them now and they take a loss, right? And so after that, if their money that they're taking exceeds the capital, it's a game over for the bank. And then somebody has to step in and save them. And we only have two options. Either we bail out regional banks if this starts happening, or we sell them to the bigger banks and we lessen the free market.
Okay, so this is what I read a week or two ago. 1,210 institutions, that's banks and what do you call them? Credit unions.
Credit unions. Yeah.
That's 12.8% of our banking system got a red warning flag signaling risk of imminent failure. 3,000 received a yellow warning flag indicating risk of failure in a financial crisis or recession. And 45% of all banks and credit unions were deemed vulnerable. Well, if the 12.8 go down, then you have a financial crisis or recession, and that just triggers the other 3,000, does it not?
So a lot of these banks are teetering, right? They're getting loans from other banks, or they're selling their assets to be able to cover if any type of run happens. So what we're saying is there are 12% or 1,210 institutions are at a point where if anybody decided to start pulling money out or we had some sort of small panic, they're not surviving. It's not happening. And that is a lot to do with the fact that they don't have the liquidity based on the short-term and long-term demands on their bank. And so when we rate banks, we have 5 different ratings, and there's 154 different data points we look at within that rating. And then we compare them to the stability across all of our data on those banks. And so we compare 6,000 data points to figure out what is the stability of this bank. And then we rate every bank A through E. Okay. And so A and B are more stable. C is in a vulnerable. That's the yellow flag, right? Mm-hmm. And then D and E are the red flag. But there's quite a bit, even in that yellow flag, that if we hit a recession, or we come into a new financial crisis, they do not have the liquidity or the cash on hand to be able to survive.
So what does that mean to the average person? I've been telling people, don't pull your money out of a bank unless unless I think you're foolish for putting more than $250,000 in a bank account, especially if you're an individual, maybe businesses, I understand. But you're going to get your money back. Now, how much your money is worth in the end is another story. But don't pull your money out because you're going to get that money if it fails. Right?
Yeah, we don't. First off, we don't want to cause panic, right?
Yes.
That's why the FDIC, who understood that a lot of the problems with these recent bank failures were they had a lot of uninsured accounts, right? So that means they were over to $250,000.
Correct.
But the first thing is, don't hedge your bets. Don't think that the FDIC has the capital to cover everybody, because they don't, right? When they came out and said, we're going to cover all accounts and over the $250,000, they're just paying lip service. That's exactly what they're doing.
I think they'll print the money. That's why I say I wonder how much it'll be worth in the end, but they'll just print it.
It's not the FDIC that will bail them out. It will be the U.S. Treasury.
Correct.
Right?
Yes.
That will bail them out. Yeah. Right. Yeah. And so the first thing I would do is never, like you said, never have over $250,000.
Okay.
And spread them out, because each account is actually insured. And so you can have one in one and one in the other and have a total of $500,000.
In the same bank?
But, yeah.
Okay.
As long as they're in separate accounts, it's the accounts themselves that are insured.
Okay. So when you say signaling a risk of imminent failure, that means if something happens, or, imminent failure usually is like DEFCON 1, the war has started. It's coming in.
So anybody that is on listening right now can go to weissratings.com and see what their bank is rated. They don't have to do anything. There's a search at the top. You get all the information. You don't have to pay for it. We do this just because we care about the everyday person. And so you can go right now and see what your bank's rated. If your bank is rated red, there's a possibility, and I'm not going to say it's happening, but if it's rated a D or an E, there's a possibility that even without a crisis, they could go under. They could fail.
So what do you
right?
do if you're in one of those banks? Because I don't want people to panic and freak out, but I want them to be safe. So what do you do if you're in one of those banks?
So right now, it's not an issue. We do not have an issue, and so we're not panicking. Nobody needs to panic. Nobody needs to go take their money out. They need to be careful, right? They need to see where their money is, see why, because you can see right there why the institution has rated that, and if it's a profit problem, if it is a stability issue, a lot of these are really small banks, right?
Mm-hmm.
And so what they need to do is they're going to be covered. Everything is covered. Credit unions are covered under the NCUA. Banks are covered under the FDIC. And if you're in one of these small banks, you're just going to be pushed into, like we saw these other bank failures to happen, into a larger bank that buys your assets.
Right. Or
it's taken over by until they can auction off the accounts. And so it's going to be seamless for them. But we have them there just so when people are looking to get into banks or looking to not have to deal with this, they know.
Let me take a break. I want to ask you about Bitcoin. I want to ask you about insurance, but I also want to ask you about the big banks. Okay. Any of the big banks in trouble?
So I can't give you specifics right now on individual banks.
Okay.
I'd love to do it, but I have the overall information. But normally I'm going to say this: a lot of the big banks are highly rated for us. Okay. Which means they're a B or they're an A. Like I'm looking at JP Morgan right now. They're a B plus. They have decent liquidity. They're a major bank, and so they seem safe. But the issue here is it's not if they're trouble or not. It's a catalyst system. Like when we saw in 2008, it's a catalyst. Like people end up holding bags for other people on bad debt.
Yes,
we have some interesting things happening here shortly. Like the commercial lending industry is going to go through a little bump in the road.
Yeah, I don't think that's a little bump in the road.
Yeah.
I mean, there's a lot of big commercial debt, especially in these giant cities. Who's going to fund these things? And then what kind of interest rate is it going to be? I mean, how are you going to renew all of this commercial debt?
Yeah, there's a lot of issues with terms coming due. There's a lot of issues with cap rates just getting annihilated. And so we're going to see big discounts. We're going to see big discounts on commercial properties. And The thing is, I was listening to a pundit the other day, not to quote somebody else I'm listening to, but they were saying that they foresee that because there's so much cash out there and people are being hesitant about getting into these commercial deals that they might not even get to foreclosure. They're just going to be bought on discount to other investors because they haven't been wanting to jump in the last year because of the crazy interest rate rises, right?
Wow.
Yeah, and so I don't know. I can't forecast. I'm not a commercial banking expert.
Right.
I'm not.
Yeah, just your rating service. So tell me, do you rate Bitcoin? I've been concerned about Bitcoin because of
Bitcoin.
With everything that's going on with the Federal Reserve and the government. How do you rate Bitcoin?
So we have Bitcoin rated right now as an A minus, and so you got to understand is we individually rate each asset. So because Bitcoin is an A minus does not mean that it's better than Apple as an investment, right?
Right.
So we rate things within their own industry. And so we rate all cryptocurrencies around cryptocurrencies. We rate all banks around just banks. And so we have individual algorithms for each one. So insurance is another one. We've been dealing with the mess in Florida, which you probably know about with the insurance. And we downgraded the backstop insurance company for the state of Florida because its citizens, because it's a mess over there. They're losing money, and if another big hurricane season just is damaging to the current state. And right now we've been kind of working with the ledge a little bit to try to help them out to fix this issue, but it's a large issue. We're based in Florida. We care about that.
Dallas, I thank you very much for coming on and being a voice of reason and also of warning and not causing any panic from anybody, but just sharing the information. I appreciate it, Dallas. Thank you.
Yeah, no problem.
All right. WeissRatings.com is where you can go, and you can see the ratings of your insurance company, your banks, et cetera, how stable are they. Do not panic. Do not pull your money out of banks. I mean, if you have more than $250,000 in an account, split it up. But don't pull your money out of the bank. It'll be a self-fulfilling prophecy. Weiss, WEISS, ratings with an S.com.